everyone, my name is Marjorie Dapanas and this is our report in Chapter 12, Taxation, Production and Sale in Other Taxes. In taxation, it is the most important source of revenue of the government is taxes. The act of levying taxes is called taxation. A tax is a compulsory charge or fees imposed by the government on individuals or corporations. The person who are taxed have to pay the taxes irrespective or any corresponding return from the goods or services by the government. The taxes may be imposed on the income and wealth of a person's or corporation, and the other rate of taxes may vary. Then, taxes are the payments of people that required to pay to local, state, and nations governments. Taxes are used to pay for services provided by government in schools, in police, or in defenses. So now, why do we need to study the taxation? So we study the taxation because it is the vital method of financing the most essential public sector activities, such as the courts, the legal system, national defense and police protection, sinabi ko kanina. In addition, it is provide the means for producing social programs such as public health services, education, and welfare. Let's proceed to specific taxes. The specific taxes derive from the fact that its rates are specific. That is, a fixed amount is levied based on a certain physical unit of measurement. Dito, sa specific taxes, these are the fixed amount for each unit of a goods or services that are sold. And this is proportional to the particular quantity of a product sold regardless of its prices. The selective application and imposition of varying tax rates may be justified on any of the following grounds. So, number 1, to curtail the consumption of certain commodities, excessive or indiscriminate use of which is considered harmful to the individual or community. Dito kung saan dapat maiwasan ang mga bagay na nakakapinsala sa ating komunidad. And in number 2, to protect domestic industry, the products of which face competition from similar imported articles. Number 3, to distribute the tax burden in proportion to the benefit derived from a particular government service. And number 4, to raise revenue. The specific taxes have on many occasions been justified on a pretext of prosecuting any of the 3 objectives mentioned above, to minimize the opposition to the tax. In reality, however, the main purpose is to raise the revenue. Dito naman, ang pangunahing layunin lang ay upang taasan ang kita. Specific taxes are compared to ad valorem taxes are criticized on the ground that they place a heavier burden on inferior quality goods. This tends to aggravate the already aggressive effects on these taxes inasmuch as inferior goods are generally purchased by those who have relatively low income. Ang specific tax dito tumutukoy sa excise tax na nakabatay sa kapasidad ng volume o anumang physical na unit ng pagsukat. Ang ad valorem tax naman, tumutukoy ito sa presyo ng pagbebenta o halaga ng mga kalakal or goods. Development and nature of specific taxes in the Philippines. Distilled spirits. Under the Administrative Code of 1917, distilled spirit was taxed at 0.38 per proof liter if produced from the sap of nipa, coconut, berry palm, or sugar cane juice, and at 0.80 pesos per proof liter if made from other materials. Dagay nanginginang nga materials sa ito, so nga kaslang yung mato. The National Internal Revenue Code enacted on July 1, 1939 retained the 0.38 pesos rate but increased the 0.80 rate to 1.30. So dito naman sa distilled spirits, mostly example dito got gins, brandies, rums, vodkas, whiskeys, and tequila. The increases in the rates have been justified on the ground of discouraging consumption of intoxicating liquors which are generally believed to be damaging to health and to be partly responsible for criminality. In fermented liquors, the tax rate on the fermented liquors was 0.04 per liter under Act Number 2339, approved in 1914. This was subsequently increased. The rate was raised to 0.275 pesos by Republic Act Number 5449 in September 25, 1968. Sa fermented liquor, known as drinking alcohols include wine, brandy, cognac, and pisco from grapes, the vodka from potatoes, as well as beers and whiskey from grain starch. Kung saan, ang rationale ay para sa buwis sa fermented liquors is mainly sanctuary. And in cigarettes, under the Administration Code of 1917, cigarettes were taxed at rates ranging from 1.30 pesos to 2.30 pesos per thousand pieces, depending on the wholesale price. The tax code approved in 1939 changed the range of tax rates from 1.30 pesos to 4 pesos per thousand stick, also depending on the wholesale price. Cigarettes, dito naman nakadepende ang wholesale price, pero patagal lumalaki ang range tax rates niya. Sa pagtaas ng rates ng sigarilyo ay nakabase sa mga medical na matuklasan sa mga paninigarilyo ay nakakapinsala din sa kalusugan. The imposition of relatively high rates on cigarettes is again justified on sumptuary grounds largely based on medical findings that smoking is harmful to our health. Gaya nga ng sabi ko kanina, mayat nga libangan pero adati kasukat na. Hindi rin kasi maiwasan dito ang argumento laban sa mga matataas na buwis sa pag-sigarilyo. Another objection to the tax is its highly regressive effects as demonstrated by the findings of the Tax Commission's Tax Burden Study. A recent argument against the high tax on cigarettes in this country is evasion, yung hindi pag-iwas or mahirap maiwasan. And sa gasoline naman, under the Administrative Code of 1917, gasoline was taxed at 0.05 per liter. The same rate was carried over under the tax code but was later raised to the 0.07 pesos per liter under Republic Act Number 56 and further to 0.08 under Republic Act Number 1435. Gasoline is a petroleum and used as fuel for internal combustion engines. Dito usarin tayo nga agpatpataray kada giti makina or cars, kumbaga. The entire collection from the gasoline is earmarked for highways, special fund that established to finance the construction and maintenance of highway roads and bridges. The tax on gasoline exemplifies the application of the benefit theory of taxation. Consumption of gasoline, which generally varies directly within the distance driven, provide the basis for determining the benefits derived. Good roads also indirectly reduce the cost of marketing goods, which is ultimately reflected in lower prices to consumers. Gasoline is used for agricultural or industrial purposes, should be exempt or subject to the lower rates. Exemplifies the application of the benefits theory. It is the taxation provides goods na sa huli ay makikita sa mas mababang presyo sa mga mababang presyo nating mabibili. Ganun po. Other articles object to specific tax. The other commodities are wine, cigars, chewing, and other manufactured products, matches, firecrackers, kerosene, lubricating oils, alcohol, coal, and coke. Bunker fuel are all its derivative or salt of saccharin and other artificial sweetening agents. The annual collection from these 14 commodities represented only about 4.3% of total revenue from specific taxes in fiscal year 1966 to 1970. So those are the subject to specific tax, the commodities. Or would I say, parang karagdagan lang sa mga natakod natin kanina. So, sales tax. Sales tax may be defined as a tax imposed on the sale of a wide range of goods or services. The general coverage of the tax serves to distinguish it from special exercise taxes such as are specific taxes which are applied on a few selected commodities. So, sales tax, ito yung tax na pagkonsumo na ipinataw sa pamahalaan sa pagbebenta ng mga produkto at serbisyo, wherein it is the coverage of the tax serves to be distinguished from special exercise taxes. In development and nature of the tax, under the Internal Revenue Law of 1904, Act Number 1189 of the Philippine Commission, a tax of 1/3 of 1% was imposed on all merchants based on the gross value of all goods sold from domestic consumption. The commodities were grouped into 3 breedings in different rates. Development in nature of the tax are mainly focuses on the merchants or the gross value of goods that are sold for domestic consumption. The multi-stage application and cumulative nature of the tax gave rise to the inequities in the tax burden. Furthermore, tax was costly cumbersome. The luxuries implies the selling price if it's exceeded or not, while in semi-luxuries, these are the imported and locally manufactured by integrated firms, and ordinary articles which includes commodity not specified as luxuries or semi-luxuries and are not subject to a specific tax or Miller's tax. The imposition of heavier taxes on so-called luxury or semi-luxury goods, which believes to be purchased in generally by the higher income groups. It is apparently designed to reduce the regressive effects of the sales tax. Ordinary articles, these are the kind to be expected in normal order of events. Let's move to tax base and taxpayer. Locally manufactured goods. The sales tax on locally manufactured goods is collected only on the first sale by manufacturer or producer to a wholesaler, retailer, or consumer. The cost of raw materials is deductible from the gross selling price before the rate is applied. Locally manufactured goods focuses on the manufacturer or the producer na nakabantay sa presyo ng nagbebenta o sa halaga ng artikulong ibinebenta. As we discussed earlier, our sales tax system follows the basic cost subtraction method of the value-added tax. Sa imported goods naman, this was paid at the customs and based on the landed cost. Prior to July 1, 1948, the importers were required to pay tax on their sales of imported goods within 20 days after end of each calendar quarter. Thus, Republic Act No. 253 was enacted on July 1, 1940, requiring the tax payment before the articles were released from customs custody. The tax paid at the customer was based on the landed cost. Sinabi ko na kanina kung ano yung landed cost. This defined to include the importance, invoice value, freight, insurance, postage, customs, duties, and similar changes incurred to the withdrawal of the goods from the customs house. What is landed cost? It is a sum of expenses associated with shipping a product. The tax paid at the customs is final in the sense that no additional tax is collected if the article is sold for more than value at which it is been previously taxed. The law was therefore further amended by Republic Act No. 594 on August 16, 1951, making the tax paid in advance at the customs final. Number 3 is exemption. To mitigate the iniquitous effect of that sales tax, agricultural products, and sales of small producers working in their own homes and exempt from the tax. Also exempt from the tax are articles exported abroad by the manufacturer or producer. Exemptions, these are the right to exclude all or some income from taxation by federal or state government. Sa pangkalahatang ito, na ipapailalim sa particular na tax or those subject na nilayon upang maiwasan ang duplication of taxes. And in other taxes, miscellaneous taxes on production and sale number 19, yet taken collectively, they account for an average of only 16% of total collection from consumption taxes. Most of these taxes are ad valorem taxes imposed on services. In amusement taxes, imposed on the general admission charges to the recreational and entertainment events. The tax may be imposed on the admission charge or on the owner's total admission receipts, but pure amusement tax is almost always quoted separately and presumably shifted to the buyer of the ticket.
Second, the tax on banks. The Revenue Law of 1904 imposed three types of taxes on banks, namely 1% on capital, 2% on the average deposit subject to withdrawal by check or draft, 3% per month on bank notes intended to be used as money. Thirdly, broker's tax. A tax of 4% on gross compensation of merchandise brokers in excess of 500 per quarter was imposed under Act Number 2541. The rate was later raised to 6% and the exemption of the first 500 gross compensation was lifted. Fourth, tax on cinematographic film owner, lessors, and distributors. A 2% tax on gross receipt of cinematographic film owner, lessor, and distributor was imposed under Act Number 588, approved on September 22, 1950. This rate is still enforced. Common carriers. Act Number 1189 leveled a tax of 1% on gross receipt in excess of 200 per quarter to keeper to stables and garage transformation contractors and persons who transport passengers on flight by the land and water, except both taxed under laws administered by Bureau of Customs.
Compensating tax is imposed when a business or an individual uses tangible property, a service, a license, or a franchise that was acquired as a result of a transaction with a person located outside the state. Prior to the enactment of the National Internal Revenue Code, goods imported for resale in the Philippines were subjected to the sales tax, while goods which were produced directly from abroad by the consumers remained untaxed, thus paving the way for tax avoidance. Next is contractor's tax. Contractor's tax were liable to a tax of 1% of the gross receipts under the Administrative Code of 1917. The rate was increased to 1 to 1/2% under the National Internal Revenue Code, then to 2% under Republic Act No. 39, and further to 3% under Republic Act No. 588. Republic Act No. 1612 of August 24, 1956, and Republic Act No. 6110 of August 4, 1969, broadened the coverage of the tax. Among those currently covered are building, road, and other construction work contractors, beauty shops, funeral parlors, vulcanizing shops, printers, and etc. Also, subject to the contractor's tax by virtue of the Republic Act No. 39 as amended by Republic Act No. 1612 are keepers of restaurants and other eating places are rates varying from 3 to 20% depending on their location and as to whether alcoholic beverages are served or not. Exempt from the tax are persons who enter into contracts to supply embroidery and apparel to foreign buyers and publishers, subject to certain limitations. It applies even to subcontractors, resulting in some form of double or multiple taxation. Proposals are being studied to limit the tax on subcontracts to the extent that they exceed the amount of the principal contract. The tax on dealers in securities and lending investors. According to Republic Act No. 6110, impose a tax of 3% on the gross income of dealers in securities and lending investors. Fixed taxes on business and occupations imposed under Republic Act No. 1189 at rates ranging from 50 pesos to 200 pesos and 20 pesos to 50 pesos respectively. General rates increases were affected by Republic Act Numbers 32, 1912 and 6110 approved on October 1, 1948, August 24, 1956, and August 4, 1969 respectively. The justification for the fixed tax emanates from the legal viewpoint that it is a tax on the privilege to engage in business or pursue an occupation and must be paid before any specified business or occupation is pursued. As such, this tax partakes the nature of a license rather than a tax on transactions in commodities or services, which generally characterize the other taxes we have discussed in this chapter. We have three categories of fixed tax on business. Number 1 is annual fixed tax. A tax of 50 pesos on persons subject to sales tax, millers, contractors, common carriers, and of restaurants. Exempt from this tax are merchants with gross monthly sales of 200 pesos or less, owners of animal, drone, two-wheeled vehicles, and small producers working in their own homes. Number 2 is graduated annual fixed tax. This ranging from 10 pesos to 12,000 depending upon the volume of annual sales on wholesalers, retailers, and dealers not subject to a distinct and separate fixed tax except merchants with gross annual sales of 2,400 pesos or less. Number 3 is other fixed taxes. This ranging from 20 pesos to 5,000 pesos on specified manufacturers and merchants including those dealing in distilled spirits, wines, fermented liquors, and tobacco products and other business establishments. Professionals and other persons engaged in certain occupations are classified into groups. So, number 1, levy the tax of 75 pesos a year includes lawyers, engineers, veterinarians, physicians, architects, certified public accountants, insurance agents and sub-agents, opticians, commercial aviators, licensed shipmasters, and etc. And then number 2 is subject to a 50 pesos. Tax includes land surveyors, chief mates, marine second engineers, pharmacists, registered nurse, chiropodists, masseurs, pelotarists, hostess, actors, jockeys, and etc. And we move on tax on finance companies. Finance companies are defined to include corporations or partnership, other than a bank or insurance company organized for the purpose of extending credit facilities to consumers and to industrial or agricultural enterprises. A tax is 1% is imposed on gross receipts of cultural enterprises. A tax is 1% is imposed on gross receipts derived by finance companies doing business in the Philippines. Another is franchise tax. Under Act Number 2339, corporate franchise holders were levied as a tax at rates specified in their respective charters. The tax code imposed an alternative rate of 5% on gross receipts of franchise holders where their charters do not specify the tax rate. Generally liable to this tax are operators of public utilities such as electric plants, ice plants, telephones, and telegraph companies. Many of the bigger firms have, however, succeeded in obtaining in their charters either outright tax exemption or minimal rates of tax. Another is tax on insurance premium. Under Act number 1189, premiums and other income received by insurance companies were subject to a 1% tax. Act number 2339 on February 27, 1914 changed the base as to include only total premiums collected. The tax code increased the rate to 1 to 1.5% but a rate of 1% was to apply during the first 10 years of the operation of an insurance firm. Foreign insurance companies were made liable to 6% tax on premiums collected. Republic Act number 39 amended the tax structured applicants to domestic insurance companies. A tax of 1% was imposed during the first 5 years of the operation, 2% during the next 5 years, and 3% thereafter. These rates were further altered with the enactment of Republic Act number 1504, which retained the 1% rate for the first 5 years of operations but made the 3% rate applicable starting from the 6th year of operation. These rates are still in force. However, there are some exempt from the premiums tax. We have 5. So number 1 is premiums refund within 6 months. Number 2, premium on account of reinsurance by a company that has already paid the tax. Number 3, premiums collected by any branch abroad of a domestic reinsurance company on account of life insurance of insured who is a non-resident of the Philippines. Number 4, premiums at which percentage tax is imposed by the foreign country where the branch is situated. And lastly, number 5, premium collected on account of any reinsurance if the risk insured covers property located outside the Philippines or the insured resides outside the Philippines, or if any percentage tax on such premium is imposed by the foreign country where the original insurance has been issued. Premium tax is a tax imposed by each state on gross premium written by insurers allocable to risks located in that state. Gross written premium, or the GWP, means before insurance ceded but after salvage and subrogation. Another is we move to Miller's tax. So Miller's tax, prior to the enactment of the tax code, proprietor and operators of sugar centrals and rice mills were subjected to a 1% tax on their gross receipts, while operators or proprietors of road factories, coconut oil mills, and desiccated coconut factories were liable to the sales merchants tax. Furthermore, to equalize the tax treatment of all these agricultural products, Commonwealth Act number 466 imposed a uniform tax of 1 to 1.5% on the proprietors and operators of all these mills and factories. The rates was increased to 2% under Republic Act Number 261. Cassava mills or processors of pineapple were made subject to this tax under Republic Act Number 3704 and Republic Act Number 6110 respectively. Taxes on natural resources and other minor taxes. The charges imposed of forest and mineral and on the use of water resources and not taxes imposed to finance governmental services. Rather, these constitute the price which the government exact for the privilege granted the concessionaires to exploit our natural resources.
The taxes on natural resources and other minor taxes are as follows.
Forest charges. Forest products, namely timber, firewood, gums, resin, rattan, etc., taken from public forests have been subject to charge since 1904. The charges presently collected on timber range from 0.60 pesos to 6 pesos per cubic meter, depending on the class of timber. The charges on firewood are 0.30 pesos and 0.60 pesos per cubic meter, depending on the type of firewood. A rate of 10% is levied on the market value of gums, resins, rattan, and other minor forest products. Mining taxes. 3 types of taxes are imposed on mines and mineral products. These are annual rentals of 5 peso or 10 peso and 2 peso per hectare on coal-bearing and other mineral lands, respectively. Royalties of not less than 0.20 peso per ton on coal and 1.5% and 2% of actual market value on gross output of gold and other mineral extracted from mineral lands covered by lease. An ad valorem tax of 2% on output of mineral lands not covered by lease. Water rentals. The appropriator of water for power purposes for a small development is charged an annual rental of 0.25 peso per horsepower for the first 10 years and 1 peso thereafter. For a large development, the rate for the initial 10 years is 0.50 peso per horsepower. Other minor taxes imposed as regulatory measures rather than for revenue purposes. These include the tobacco inspection fees collected upon the inspection of cigars, cigarettes, and other tobacco products intended for exportation, the firearms tax collected from dealers of firearms and ammunition and from persons authorized to possess firearms, and the fees for sealing of weights and measure. Affluent consumption tax. A well-known businessman has come up with a package proposal to revise the tax system. He has proposed the gradual replacement of the income tax with what he calls an affluent consumption tax in order to more effectively collect taxes from those who should pay, and in order that our tax policy may promote instead of obstruct. The affluent consumption tax is proposed to be initially collected on the more obvious affluent expenditures and will allow such tax payments to be credited against the individual income tax. The following observations can be noted which may tend to negate the objectives of the proposal. Some of the consumption expenditures proposed to be taxed could hardly be called affluent, as they affect even the low and the middle income groups. All of the affluent expenditures are already subject to tax, and concrete proposals to increase the rates of most of the existing taxes have either been approved or filed in Congress. The most objectionable feature of the scheme is the provision of tax credit, since payments on affluent consumption expenditures will be used as tax credit against the income tax. Some expenses which are not deductible under the present income tax system will in effect be allowed as a deduction.
The summary of production and sales others taxes. The case for the consumption taxes in the Philippines, as in many countries, lies primarily on their administrative feasibility and high revenue productivity. Our government need to renew has been mounting, not only because the government is called upon to take a direct hand in accelerating the country's growth through. Furthermore, if our tax is expected to generate more revenue under prevailing conditions, it seems inevitable that consumption taxes will have to continue playing a major role. The aggressive effect of this can be minimized by pursuing reform in our income tax and other progressive elements of the taxes system within limits compatible with other predetermined economic and social goals.